is up, everybody, and welcome back to the Fresh Finance Podcast. My name is Thomas Elms, and I have my co-host here, Kyle Ryan, as always. Today, we're going to do a little bit of a shorter episode. We just really wanted to find a timely opportunity to touch base on the bank situation, both here in the U.S., but also globally. Some of the headlines that everybody has seen on the bank situation. We also just wanted to do a quick recap on honestly just what happened in the markets this last quarter in 2023. I think there's a lot of things that we can cover quickly that we think are really important to touch on. And, Kyle, would love to just kind of get your introductory thoughts on the banking situation. I know that the things that we're going to kind of highlight talking about are Silicon Valley Bank. They're obviously the first one to run into this situation, and then Credit Suisse. Would love to just get your first take, your first thoughts on this part of the conversation.
Yeah, well, I'll tell you, when it first unfolded, I remember that Friday when it happened, my first thoughts were of panic.
Yeah.
Naturally, right? Because at that time, all we knew is that there was a serious issue in the liquidity of banks. We knew that there was a run on banks, which got exacerbated in recent years because a run on banks is no longer a line outside the bank. It's looking at your phone and whoop, I withdraw all my money. Mm-hmm. So there was a lot of concern there. And it really started with the fallout of Silicon Valley Bank. In a lot of ways, that was a failure of the regulators, not noticing that the practices, the things that Silicon Valley Bank were doing were going to ultimately lead them to this situation. They had a lot of risks that could have easily been hedged. That's not really the point of the discussion here, though. The point of the discussion is now what, right? We had this panic moment on that Friday. What happened? A couple things happened. The Treasury Department, Janet Yellen came out and essentially guaranteed like all deposits, right? So before we get into this, let's talk about FDIC insurance. You go to a bank, you open up a bank account, you have FDIC insurance up to $250,000 in that bank account. So if you have less than $250,000 in your bank account and spread out between different bank accounts, what have you, can't go above $250 in one bank account, you have nothing to worry about here. This does not impact you. You have insurance to protect the money. What happened was a lot of millionaires had millions of dollars in a bank account. There was a run on the bank, and the federal government came in and said, okay, if there is a systemic collapse potential because of a run on the bank, we're going to step in and insure all depositors. They did not insure the investors in the bank, the stakeholders of the bank, the bondholders. You invested, you lost, right? They're not insuring that, but they are insuring people that had their money there, want to keep their money there, shouldn't have had to lose it, right? A lot of people were saying, oh, well, you have to do due diligence in the bank. Don't want to get too far into that either. It's not really feasible. But essentially what happened was there's almost a run on the banks. People were concerned there wouldn't be money there. That concern was lifted. The contagion spread of that throughout regional banks was stepped back a little bit. That concern isn't there. It's not completely alleviated.
Yeah.
And most importantly, this wasn't a domestic issue. This was international. We saw it happen in the Swiss banks too. We saw Credit Suisse have to get bailed out by UBS over in the Swiss banks. Mm-hmm. The Swiss are known for their financial savviness, so it's an interesting thing going on there.
Yeah.
My last thing on it would be what caused it. What caused it was, again, risks that were unhedged that had to do with rapidly rising interest rates. Rapidly rising interest rates devalues your bonds. And when investors say, I want my money, you have to sell those bonds as the bank, which are not worth what they were when you purchased them. And you create this run on liquidity impact, which in a nutshell is really what happened there.
Yeah. And, kind of re-hitting on the FDIC insurance.
Yes. Yep.
It's just so important to recognize, especially now. I think this was a good wake-up call that we haven't had in a while, that this is still a possible event. And I had a client in particular, and I think this goes with anybody, but they lived in California, in Southern California, and they wanted to take advantage of the rapid price appreciation of their real estate property. And they sold the property and wanted to move to Arizona. Now, they moved out to Arizona and actually moved in with their children for a very short period of time. But when they first did it, at one point in time, they had much more than $250,000 in a bank account. And just to give a slight distinction that you want to make sure of, if you have a joint bank account with maybe your spouse, the FDIC coverage is 250,000 per person. So it can go up to 500. So that's a good distinction. But they had more than that in one account. And what I'm so happy about is we were able to have a discussion after they sold. They let me know that that's what they had done. And we made adjustments to ensure that those monies were split up between three different banks. And it's not funny, but it's interesting because we had a conversation the week after Silicon Valley Bank went under. And it was kind of that not I told you so moment, but hey, I'm really happy that we went ahead and made this decision. Now they didn't have any money at Silicon Valley Bank, but it just is kind of a reminder, hey, this is still possible and we need to really respect these insurance limits because it can happen. And you were talking regional versus global banks. This is also a nice little reflection in the fact that it's not just the small mom and pop banks that can go under. Credit Suisse was a major global bank, not only on the banking side, but also on the investment side. So these things are possible, and just recognizing that and making sure that your monies are placed in the right ways that they match insurance limits are really important. And I would even say if you have more than 250,000 in a bank account, you might want to consider trying to allocate those monies in a possibly more efficient manner, depending on, that's going to depend on your circumstance. But, that's kind of my take on the situation is recognizing that some things are out of your control. I know you talked about, almost doing your own research on the banks that you utilize. There's only so much information that you can grasp on your own. So kind of that's something that might be a little bit out of your control, as you said. Just making sure you're doing things that are within the limits, I think ultimately is the most important thing there.
Yeah, and following up on the FDIC protection, there's also what's called SPIC protection, which is for securities. So, you have too much money in the bank, you can open a brokerage account and throw it in money market. So you have protection elsewhere. One thing about, well, big banks versus little banks, right? The contagion impact here in the US was the fear was around regional banks. Now, again, we're getting a little into this conversation more and get your tinfoil hat on, but the fear was that regional banks would collapse and that we would have this conglomeration of these large national banks, which, Jamie Dimon recently came out with his annual shareholder letter, and he runs JP Morgan. They would probably benefit from the consolidation of those banks, but he even said it's great for the economy to have small regional banks. It's great for competition from even the larger banks' perspective. They get less regulation if they're not an oligarchy of banks because there's no regional banks.
Yeah.
U.S. banks very, very well capitalized since 2008. So they're less of a concern than the regional banks, but it's just worth noting everything going on. So at the end of the day, the panic was on that Friday that the news dropped about Silicon Valley Bank, in my mind, was well deserved, but that panic was really alleviated, at least for me, over the weekend when the creditor protection of your deposits from Janet Yellen was insured.
Yeah. Yeah. And I'm curious to see if any additional regulation comes from this, because I know that there was some private equity conversation as far as investments that, had to deal with Silicon Valley Bank, and we won't get into that. But I'm curious to see if any additional regulation on banks comes out at some point in time because of this situation. Who knows? We'll see. But kind of transitioning over to this first quarter, just kind of talking about where the market started at the beginning of the year through this bank situation, which is a little bit more recent, kind of on the back end of the first quarter, and just kind of looking at where things are. Can you kind of talk numbers here, where you got your sources to, just so it can be compliant, kind of where we're at market wise this year?
Yeah, what a roller coaster of a year it's been, right? All right, so let's put some numbers on the quarter. So to start the year, and these numbers are all according to Morningstar. So to start the year, NASDAQ was closing in a little bit over 20% already this quarter. That's a huge rally in just a short amount of time. The S&P 500 on the year, again, according to Morningstar, was right around 7.5%. The Dow, which is mostly consistent of the value stocks, typically more so than the other two, was the laggard of the three, closer to 1%. So it's been the tale of two halves the start of this year. January, we came out strong. The market was rallying. February, we kind of pulled back a little bit. We'll get into the reasons behind these. A lot of it is interest rate related. which I find fascinating. And then March, not to use the same term, but was a tale of two halves. In the beginning of March, we had the banking fiasco, if you will, which that concern drew the markets lower. And then this in the latter half of March, we really rallied again. I mean, the last 3 days of the quarter were fantastic.
Yeah.
So really positive start to the year so far, especially comparing it to last year. So encouraging stuff right now. And we'll get into where we see it's going, but so far so good.
Yeah. And I think that this note is not that Kyle and I in any way are saying that this is just going to continue, because I think that I can say for both of us that that's not our contention, but kind of recognizing what happened last year, especially in the first quarter, because the first quarter was rough last year, and recognizing that if it can go down like it did last year that quick, it can also come back up that quick as well. But also just refocusing that long-term mindset based off of this real life situation, because what I fear is a lot of people who invest their money got tired just in that fourth quarter last year of looking at statements or looking on their accounts, seeing that red. And I would say, quote unquote, they de-risked or got out of positions, and they missed out on the opportunity for recovery. And, I think this is not a recommendation by any means, but just recognizing that times like last year can happen. They will happen in the future at some point in time, and recognizing that the recovery, normally follows suit pretty quickly after that decline, and trying to make sure you participate in that. It's just all about kind of getting out of your own way in a degree. That's kind of how I would almost describe that.
You couldn't have said it better. And what I've heard and saw a lot of people doing last year was, with the increase in interest rates and the increase in yield you can get from high yield savings, money market CDs, we saw a lot of people,
A lot of inflow,
bail on the markets and go to those fixed income alternatives, being CDs, which, look, at the end of the day, 5% CD for the right people, absolutely great. 5% guaranteed rate of return. That is something, right? Taxable, of course, but that is something. There's something to be said about it. But that clients myself, they pull out of, despite our recommendations, pull out of the money market in June at lows. People typically pull out of the market, not at highs. They pull out of lows. Then they're like, I'm just going to guarantee myself 5%. Miss the whole rally. It's, this is one specific example. It doesn't guarantee any future results, but it is very important that when you're and you never know when you're at the bottom, right? When you're close to the bottom, all you're thinking is fear. It's just going to keep going from here. But sometimes locking in that long-term rate of return, it can be a good opportunity. But if you miss the recovery, it could really hurt you long-term.
Yeah, absolutely. And I did want to, focus a little bit of this conversation on, what you're interested in. And that's kind of the difference between the federal funds rate and what U.S. Treasuries are actually yielding. And I know that that's something that you wanted to talk about. Can you just kind of walk us through, your thoughts on that and what you're actually trying to convey and these differences?
Yeah, it's fascinating. I love this. So when you look at the Federal Reserve controls interest rates, they can either lower them, they can increase them to help spur the economy or help dampen the economy for various reasons, right? Get us out of a recession, lower inflation, XYZ. So they control interest rates. Now, the bond market prices in the future of where they think interest rates were going to be, right? Mm-hmm. So let's go all the way back to the beginning of 2022. Now, can you take it back a step further and say, remember when inflation was transitory according to the Fed, and then we started raising interest rates really rapidly to catch up? Okay. Start of last year, we hadn't risen rates at all yet. We're going to start rising rates. We know that the Fed starts rising rates. They went 0.25, 0.5, and then they started hammering 0.75% for a few months there. There was a point in time in which the Fed and what they said they were going to do was out of line with what the bond market was pricing in. Mm-hmm. Now, this causes a lot of volatility, and usually not in a fun way. The bond market had one of its worst years in its history last year. I don't have the number right in front of me, but it's one of its worst years because interest rates were rising so dramatically. So the Fed and the bond market were really disconnected with where they said that rates were going to go. The bond market said that there was going to be cuts earlier. The Fed was sticking to their guns. We are going to be higher for longer. When there's a disparity there, you'll have bond yields. Who do they believe? Do they believe the Fed or do they believe the bond market? Which is really interesting. The saying is, don't fight the Fed. The other saying is the bond market's the smarter market of the two, bond market and stock market. So more technical, less emotional. So what happened at the tail end of last year, kind of going into this year? There was a huge disconnection. As the economy started to decline in some ways and future progression started to lower, the market actually came in line with the Fed's projections. They said that we were going to raise interest rates more. So the yield started increasing, right? Mm-hmm. So what happened now, the Fed and the bond market are in line. Then comes the banking crisis, the banking fiasco, whatever you want to call it. So everything's in line where the Fed says we're going to raise, bond market says we're going to raise. That is good for just lower volatility. No one likes surprises in the markets. No one likes surprises with money, right? So now they're in line. Banking crisis happens. Fed does not talk every day. Bond market reacts every day, except for the weekends. Fed came out and said, we're data dependent, which means they're saying, we don't know what we're going to do. We see the data. They don't know what they're going to do. The rates, the odds of a rate hike right now are very close to 50-50 come May, probably 40-60 right now. They're changing every day. But Fed still says we're going to raise rates. Bond market saying, no way. There's currently 4 rate cuts priced into this year. Fed is saying we're probably not going to raise rates till the end of this year, maybe December, more likely 2024. Bond market saying 4 cuts this year. That is a huge discrepancy between the two of them. Bond market yields have been all over the place. That has been the tale of this quarter so far from a fixed income perspective. And interest rates tie right back into the equity market. Interest rates very much impact, say, technology stocks, because if you're doing a lot of research and development, you're spending a lot of money, lower cost of capital, you can spend a lot more for cheaper. Mm-hmm. Higher interest rates hurt these tech stocks. So we're talking about technology doing almost 20%. Why? Because the yields, because the bond market saw what happened in the banking situation and said rates have to get cut. We're going to potentially go into a recession here. We have to start seeing into the future. Rates got cut. Technology does that, right? So in a nutshell, if you call that a nutshell, that's really what happened, right? So there's just a huge discrepancy between what the bond market believes and what the Fed is, and that's where we are today. Either one of them is going to come up. The bond market's going to come up, Fed's going to come down. Why would the Fed come down? You cut rates because you have to, because we're getting close to a recession. There's economic circumstances that are dire. Bond market's counting that in. Fed's not. Very interesting.
Yeah. Yeah. And I think that really kind of depicts the actual complexity that sometimes comes in with the bond market. Because I think that most people think that you can just, buy a bond at 4%. And this is an example, but buy a bond at 4%, it's just going to stay there. And, then it's going to mature at some point in time based off of that specific bond. And then you'll just get your interest in your money. And then you can just go buy a new one. And there is a lot of complexity that can sometimes run in there. And I think that's important when it comes to having an advisor is having somebody that recognizes that and has the ability to explain it to you in a way that you can understand, but also can build out a portfolio that adequately reflects what you're trying to do. Because sometimes trying to just do a bond portfolio strategy on your own can be very, very tough. And so just kind of evaluating the efficiency there, I think, is really important.
Yeah, I don't anticipate, and if you are, my apologies. I don't anticipate any of our listeners being bond experts, because that is some serious. But I'm not a bond expert. I just know enough, to talk about it. It's just bonds are very interesting, but they're more mathematical. They're less emotional. That's why it goes by these numbers, goes by these expectations. You throw in equities, there's 1,000,001 other variables. I mean, we saw it in 2020, 2021. You give enough people enough money, you can get anything to go up, right? Mm-hmm. Bonds don't usually work like that. It's what's called smarter money in bonds.
100%. Well, that's about all I had. Do you have anything else that you wanted to talk about?
That was it. Again, just fixed income being so high, it's just really intriguing to go into these fixed income alternatives. But again, the history of the bond market has shown more often than not, if you get into investable bonds, like an investment grade bond or something, over time that more often than not has outperformed what CDs will give you. So if you're considering having that conversation, I'd recommend reaching out to an advisor, discussing how it works out in your specific circumstance, because that's a huge move we're seeing today. And there's nothing wrong with getting a guaranteed 5%, just has to be right for you.
Yeah, absolutely. Perfect. Well, thank you to everybody watching, listening, doing a little bit of both. Really appreciate your guys' time. Kyle, thank you for your insight today. And if you ever have anything question-wise that you want to ask us, or if you maybe have a topic that you'd like us to talk about, please feel free, reach out to us. We've got our social media links, emails, all linked up on all of our platforms. So please feel free and reach out to us, and we will see you next week. Thanks so much.